Do you think the Fed will achieve a soft landing?
That's the big debate, you know. The Fed's in a real sticky situation because people want them to curtail inflation. What they're trying to do by raising interest rates, and they've raised them really fast, but everybody's known that I mean, everybody that's paying attention to interest rates, so not Silicon Valley Bank, but everyone else, uh, they should, they've known that these rate increases were coming. Now, so what they're trying to do, increase the unemployment rate, slow the economy down, right? Get some people laid off to try to bring down that overall level of inflation. And when they do that, there's kind of uh, colloquial term that people use that say, "Okay, we're going to see what bends and what breaks." And what broke was Silicon Valley Bank, right? And some stuff's going to break, some stuff's just going to bend. Some businesses, some banks, they're just going to lose a little bit of money. They're going to lay off some people. That's kind of the hopeful soft landing issue. If a bunch more things break than just bend, that's the hard landing. And you know,
Is there any way to gauge that? Because it feels like a lot of stuff is breaking. I mean, especially with the bank situation. So you had Silicon Valley Bank, then you had Signature Bank, then you had
mhm.
Credit Suisse. Is that just are we expecting more banks?
Well, I don't know. And this is the thing. Anyone holding really any asset, almost all assets on a bank's balance sheet the value of those assets are going to go down as interest rates go up. So when you value a company, do just a basic calculation of the value of a company, you discount the future earnings of a company because dollars aren't worth as much in the future. And there's a risk free rate of return if I could invest in treasuries today. So anytime interest rates are going up, if people think they're going to stay up for a little while, all the value of the assets are going to go down for banks, including treasuries. If the value goes down enough, we can have serious problems, right? Which is what we had in the Silicon Valley Bank uh, situation. And then there's always the contagion issue because no one knows who's holding what. This was the big thing in the '08 financial crisis, is that nobody knew who was holding what of other people's, liabilities. So you can have a situation where one thing fails, which causes this cascading effect, this ripple effect throughout the economy. Who knows, though?
That's the problem is
Yeah.
you can't see it coming. You just gotta
Yeah.
buckle up for the ride.
Well, yeah, we do. And, I'm sure that at the Fed, they're doing a bunch of modeling see what they would expect to have happen with interest rates increasing. Um, who's holding what interest rate risk. But again, they have to be actually doing the regulation. They have to have accurate information that if we move interest rates from 5 to 6, this is what is going to happen at that bank.